So let's say you go buy a short-term rental for $1 million. You've expensed everything in repairs and maintenance. My CPA said it's better that way. As long as it was under $2,500 per item, I can do that. And I'm like, but you can't get lending, can you? Let me tell you what the real law says.
If the loan officer would have asked them that question, and they would have had the knowledge, of course, about the product, they would have only had to have put down 10% and had a much lower interest rate.
That is incredibly valuable.
And people just can walk into these deals feeling more comfortable that they're able to keep more money in their back pocket.
Welcome to another episode of the Hidden Money Podcast. We are going to be bringing to you a short-term rental kind of package here. And today we are going to have an amazing guest because no matter where you're at in the short-term rental process, whether you're just kind of saying, I'm interested in buying a short-term rental, or you're already looking at homes, there's one very important aspect that everyone covers, and that's going to be financing and lending. And how do we creatively fund our short-term rental purchase and maximize our cash and our tax savings? That's what we're going to talk about today. So I'm just super excited for this episode.
It's like you kind of have to have money to be able to buy a short-term rental, or someone else's money, and it's hard to get it. You need it. As we grew in our practice with short-term rentals, clients were looking for inventive ways and different ways of lending. We went to lender after lender, and they all said, you can't have a 10% down loan on a short-term rental. And thankfully, we found this guy who we're really, really blessed to have, Jeff Chisum. I call him Mr. 10% down in the short-term rental world, but he does a lot more than that. You absolutely can, and it's legal, it's legit with the federal guidelines to buy a short-term rental 10% down, but there's a whole lot more to it than that. Jeff can help you get the property and get the lending, but we're going to talk about a whole bunch of important stuff regarding lending with short-term rentals. Jeff, please tell us about yourself.
Yeah, well, I appreciate the opportunity to be here and join you guys and be on the podcast, so thank you very much for that. But yeah, Jeff Chisum, I've been originating mortgages since 2008. And
that's the year you started?
Nice. Why not?
It's going to sound familiar to a lot of people, and yeah,
PTSD just flared up in half the audience.
Yeah, exactly. Well, I call myself a survivor, and I will say, getting started in the business around that time, learned a lot, persevered through a lot, but it was a tough time. So. Yeah, kind of fast forward, I started in consumer direct with some of the big banks, retail banks, and then decided I'd really like to go out and branch out on my own. So started self-sourcing my own business, and by 2008 had achieved top 1% loan originator in the US, maintained that ever since then. And then in 2020, we bought a lake house with the 10% down second home occupancy loan. And basically up to that point, you know, my primary business was helping people buy their primary homes, just like most loan officers. But probably 5 or 6 years prior to that, I received one of these industry bulletins and just happened to open it up and read it and thought it was kind of a game changer when it came to second home loans, in that they were changing these policies, and really come to find out it was to keep people out of the gray area where they felt like, oh, I shouldn't be renting it. I'm the only one that should occupy it. Mm-hmm. So Fannie and Freddie knew how people were utilizing these properties, and were changing their policy to keep people from feeling like they were in this gray area. So I used that to my benefit, bought my first lake house, and then through that, just found out that there was a lot of misinformation out there around the product, around the policy. And a lot of it was because people were talking to their guy. You know, they were going to go talk to their mortgage guy they use on their primary residence and just kind of explain the scenario. So, you know, I'm going to go buy a place and I'm going to go buy an investment property is how it usually goes. And as soon as they hear investment property, they automatically jump to, well, you need 20% down, 25% down, we'll put you in an investment property loan. And if they would have just asked a couple more questions it would have set them on a whole different road of lower down payment, lower interest rate. And that's simply, do you plan on occupying this property at some point during that first year? They're like, yeah, we plan to go to the beach as often as we possibly can.
Yeah.
And when we're not there, we plan on renting it out on a short-term, basis through Airbnb, Vrbo, whatever the case may be. So if the loan officer would have asked them that one question, and they would have had the knowledge, of course, about the product, then instead of putting down 20% and having a rate that was about 1% higher, they would have only had to have put down 10% and had a much lower interest rate. And the reason that I know that to be the case is I'm still having conversations 6 years later where people are still being told that same thing. So
Yeah, all mortgage officers or loan originators, they're not created equal. It's very similar to CPAs, right? And tax strategists versus tax preparers. We see that all the time in our business. I kind of think, and this is why I think I get along so well with you, is you're kind of like in our groove in what we do for our clients. You look and understand the rules and help apply those rules to the benefit of your clients versus trying to just fit one size fits all, right? And understand it. And yeah, I mean, a lot of, let's face it, just like a lot of tax preparers, a lot of loan originators, they just know how to fill in boxes on a spreadsheet and they don't think. So we're excited about that. Now let me just point out what you just said and how that is incredibly valuable in tax planning. So let's say you go buy a short-term rental for $1 million, because I can do the math in my head. Doesn't have to be $1 million, but I can do $1 million in my head, I think. Kevin's going to check me.
We'll see.
We'll see. You buy a house for $1 million. If you have to put 25% down or 20% down, $200,000, and that property is making cash flow in like $60,000 a year, right? That's $60,000 a year cash flowing each year out of the $200,000 that came out of your pocket. That's a 30% cash on cash return. But if you only have to put $100,000 down, that's a 60% cash on cash. You double your cash on cash return. That's one thing. But then when you put $100,000 down, you buy $1 million property and you're material participant, you qualify for the short-term loophole, don't worry, we'll get there with other episodes. If you can do that, that $100,000 just gave you somewhere between $250,000 or $350,000 deduction if you just do a cost seg. Or if you do a purchase price allocation, you can't always do it, but we'll get to that again in a different episode. Now you're saving $700,000 of a deduction, not taxes, but it reduces your income by more cash flow that comes out. So for people that are in the 37% federal tax bracket, now that we have 100% bonus depreciation back, your 10% down can actually be less than you get in tax savings. You can get a bigger refund that covers your 10% down.
You get paid to buy real estate.
Yes.
Because that's the whole thing with tax is I don't care if you put 50% down on this is a tax play, but if you put 50% down or if you put 10% down, your tax savings are exactly the same. It doesn't matter how much in cash you put down versus how much you leverage. Now we want to be careful that we don't over leverage and wake up one day in millions of dollars of debt, but that's something you got to manage your own personal finances with.
Oh, no, I just want to point out, it's okay to have $1 million in debt, millions of dollars in debt, as long as you have a lot more in equity. That's okay.
Yes,
That's
if
okay.
equity's going up and your cash flowing,
Yes, absolutely.
But whether you finance it or put cash down, you're depreciating the cost of the short-term rental or the property. So let's put as little cash as we can. So long, but we also have to walk through cash flow on a monthly basis and make sure, the less you put down, the more you're going to have to actually rent that property out to cover the mortgage, to cover taxes, expenses, and things like that. So
yeah, the numbers always have to work. The numbers always have to work, but what I've seen is the opportunity that's been created because of the 10% down is not as intimidating as a number.
It's a lower hurdle to jump over.
It's a lower point of entry. It's a smaller barrier, and people just can walk into these deals feeling more comfortable that they're able to keep more money in their back pocket. So, they're able to really be aggressive with setting up the property they want to, or maybe they're keeping it to do another one. But yeah, to go from this mindset of I need this with a 20% down payment to Now I've got something that is very comfortable for me. Really puts people in that position where they feel like they can take action, and ultimately, it's good to see people have kind of an idea of what they want to do, but now they see that it's feasible. They're moving forward. So that's really been fun to see over the years, is just people taking action, because now they have this doorway they can walk through versus they feel like they're kind of stumbling, climbing up a mountain.
Yeah. And can you give us a little kind of example? Let's say someone bought the traditional investment property loan on $1 million property versus the 10% down. What is the rate differences in those two products, and what does the monthly payment differ on those two products? Generally speaking, and knowing that rates fluctuate, but
and credit and all that. But
so I'm not going to do the payment math in my head, but I will tell you. I will tell you from an interest rate standpoint, you're going to see a difference in at least 1% in the interest rate,
least, yeah.
And then the fees that you're going to have to pay, because it's an investment property, are going to be significantly higher. So you're going to pay probably on a deal today anywhere from 2 to 3 points to lock in the interest rate, just because they're going to tag on these loan level pricing adjusters because it's an investment property. Wow. So it's significant from that standpoint. But yeah, I'm not going to do the PITI payment on the cuff. Yeah,
I've seen you do it before. You just don't want to do it because we have video rolling.
Right.
and we have to hold you to it.
That's exactly right. It's recorded. Yeah.
Someone's going to actually be at a computer doing the math and be like, this guy, no.
Yeah, exactly.
I want to follow up though on what you were saying about how having that smaller down payment really opens up and just opens up this opportunity for a lot more people. You and I, we all have shared multiple clients, a lot of clients that have been very trigger shy about pulling the trigger on their first property. And they came out with the 10% down. And with the 100% bonus depreciation back in the day, and now it's back and here to stay, Lord willing, at least for the time being, people were able to go and put this down. They were nervous, and then they got the property up and running with you. And they came to us and we did their taxes, and they got that 10% back, or really close to it, or more than that. And they've operated this property now for half a year, and they're realizing, hey, this is cash flow and it's paying for itself. They took that money and went and did it again. And it's like, Sean Moore always calls it parlaying that same down payment over and over and over again. And how many clients do we have that started with nothing and in 5 years have 6, 7 properties? That's how you build equity. That's how you change your life. And you're using the tax code to do it. You're using reasonable mortgage laws to do it. You're buying fixed rate mortgages. So you know what your downside is. You can prepare for that. You're not getting out over your skis. That's life changing.
Well, and the idea that you're going to have to stack 20% down payments to build a portfolio of these types of properties is overwhelming. And my typical client is usually high income earner, very well educated. They come into a position in life where they feel like this is something that they've wanted to do. They wanted to invest in real estate. They've been told they should diversify and invest in real estate. Now they're being told there's significant tax advantages to do it as well. So just to have that idea of I only need 10%, and then if I can, duplicate this, I'm going to be in a great situation by the time I get to an age where I want to kind of slow down. So my typical client, doesn't have millions of dollars in a bank account just ready to go. But 10%, along with a cushion, so they can do it comfortably, that's my average client.
Okay. And I think you mentioned it a little while ago, where if you could put less down, you can finish this property out to your specs that you want. Because if you put 20% down, and this is going to actually be a trader business, you're actually going to want to generate revenue. You're not going to go to IKEA and get a bunch of shelving and bedding, right? So you're going to have the capital to actually put into the business, which is also tax deductible.
Absolutely.
So you're getting the same tax deduction on the house as you would if you did 20% down versus 10, but you have more capital to play with, either wiggle room for vacancy to get this thing up and running, or to improve it.
And make it the best performing STR in the market.
Yeah, and I can tell you from personal experience, having bought a lake house and another short-term rental, you never want to go into the deal feeling like you're going to have to pinch pennies.
You're strapped, yeah.
To get it set up that you're strapped, exactly right.
Rarely does it cost less than you were expecting, but more often it costs more than you were hoping.
That's exactly right. And you need to have that mindset that I have this money that's still left over, that's set aside, and we're going to invest it in the business. We're going to make this property stand out. We're going to make it, special. Because those are the ones that are going to perform. The people that bought properties and they went into the deal and they were drained, so they're basically listing it as they originally bought it. Mm-hmm. Those are the ones that are having a hard time in the business because.
And we've seen a lot of those, unfortunately.
Yeah, because short-term rental market has been around for a long, long time. And prior to 2020, before it became really popular, those people were, they had clean sheets and silverware and
it was like some of the basic 2 to 3 star motel,
right.
But you were getting a house. It's not that way today.
It's not that way anymore. The game was stepped up, after 2020.
A lot more competition.
There's a lot more competition. A lot more people educating people on what you have to do, and it takes money. And you have to go into it with that mindset that I'm not going to just, hold tight to what I have. I've got to be ready to spend some money.
Gotcha. Mm-hmm. Well, in interest of time, we could talk to you for an hour, 2 hours about this, and I have many, many times. But so let's say you get your first 10% down, you got an STR, it's working well. Can you do it again? That's your second home loan, right? Tell us about that.
Yeah, absolutely. Well, and we've got a friend in the business, Sean Moore, that has coined this phrase, lifestyle assets. Mm-hmm. And one of my favorite stories a couple of years ago, talking to a guy, and I rarely talk to anyone that's just looking to buy one. They want to build a portfolio of these lifestyle assets where they can have one in the Smokies, one in 30A, just different parts of the country. And that's the ideal model if you're going to continue to use that second home occupancy loan, is not to concentrate on one area. You're going to use that product in different parts of the country. But
it's called a second home. But now that you've had a second, you got 2, right? Are you stuck?
Well, so
3 second homes?
Yeah. Well, just to finish my story about this guy, because I loved it. It was classic. And the older I get, the more I can appreciate kind of his business model. He said, Jeff, my idea is when I get to an age where I'm ready to slow down and just kind of travel full time, I want to be able to chase 72 degrees year round. And I was like, that is perfect. I'm in on that model.
Yeah.
But to answer your question, you can have up to 10 mortgages in your name, and there's nothing to say that all 10 of those weren't originated as a second home occupancy loan. So yeah, you can have up to 10, and your limiting factor is probably going to be bumping up against a debt to income ratio at some point. So Fannie and Freddie will let you do it 10 times.
What if you're married?
Yeah, that's a great question. And, kind of next level strategy when you have dual income earners in a household where each of them will strategize to have 10 in each of their individual names. So potentially collectively, you could have 20 of those.
But that would include your primary if you have a mortgage on your primary.
It does not include your primary.
It does not?
Yeah.
So you could have 21 homes building equity for you, all with 10% down.
Yeah, that's exactly
You have to do one per year, and there's a lot of detailed rules, like how far it has to be from the home you're living in and things like that. But that's where they can reach out to you and learn these rules, right?
Right, because that rule doesn't exist, actually.
Are you kidding me?
Yeah, there's no mileage requirement. It just has to make sense to the underwriter as to why you would be using that product to purchase a property that's relatively close to where you already own real estate. So I had a great example here in Dallas where she just happened to be a physician, but lived in the suburbs, and then her kids swam competitively. It was 20 miles away, so relatively close, but as you know, in an area like Dallas, 20-minute drive could turn into an hour real quick. So she wanted to buy a property next to the swim center. So, when they were having meets, they could go down there Friday, spend the weekend, or if it's the summer and they've got, camps that they're going to, they have the house. And even though it was relatively close, it made sense to the underwriter through an explanation.
Cool.
But those are some of the information out there that...
You just said something important, though. It made sense to the underwriter through an explanation. So you work with underwriters that will listen to explanations, not all underwriters.
Check the box underwriters.
Yeah. So we've got the bigger and better rule. So take the Smokies, for instance. You buy a 2-1 in the Smokies. You've been using it for a year and you find, hey, we just can't have extended family. We want to go look for another one that's, 4 bedrooms, 2 baths, indoor pool, better view. That would be a scenario where it makes sense where you could use that product, the 10% down, second home occupancy in the same market area. So there definitely are some exceptions.
Okay.
And you hit on another thing I want to talk about is the debt to income ratio and qualifying for these things. Because we see this all the time with lenders, because if you strategize with these short-term rental purchases on your tax return, you're going to show a lot lower income. If we're doing our job and you've hired us.
A lot lower taxable income.
Yes.
Not cash income, but taxable income. Yes.
Is going to be sometimes zero. Sometimes we're in a negative and we have a net operating loss carrying forward that this short-term rental property may eat up all your income plus some next year. But then you're in a kind of in this hypothetical bind, because now you're going to show tax returns, and who's going to lend money to you if your tax return says you made $0? So how does that work if they came to you and they tax plan with us? We're like, all right, here's John and Jane Smith. They made $0 on their tax return. Will you give them money? I swear they make it.
Yeah, so one thing to know is that we can add back the accelerated depreciation into the income calculation. So it's not going to count against you. When we get to a point, so the other thing to mention would be if you're running that income through Schedule E, we only need 1 year of that income history to be able to use it for the next one for qualifying income. If you've got so many write-offs that you're showing a loss and adding back those write-offs aren't going to make a difference, then we can look at a DSCR loan, so debt service coverage ratio, where we're more concerned about what the property is going to do from an income standpoint than what you made on your personal tax return. So we don't even look at the personal tax return. We don't look at your personal income at all to qualify you for that debt service coverage ratio loan.
And you can't get 10% down on the DSCR?
You cannot.
Bummer. But you get off the hook, I guess, if you're not showing the income, that you could qualify for a loan that income-wise you're not qualified to take, so long as the property is generating revenue and it has a history of cash flow.
Yeah, that's absolutely right. It's going to be for someone that's bumped up against the debt to income ratio ceiling, or a lot of my clients that use the DSCR loan are self-employed. So what they show on a tax return isn't going to qualify them for a fully qualifying loan where we've got to verify income. So that's a lot of who is using that DSCR loan is going to be self-employed. But yeah, the ratio is gross income. That property is going to show potential gross income that's going to match the principal, interest, taxes, and insurance payment.
Now let's talk about that for a second. So if we're reporting on scheduling, this is where you got to be careful and strategize with your lender and your tax advisor. Because let's say you have a property, a short-term rental, you buy it later in the year, you get it up and running, you put it on Schedule E, and you rent it for, 3 weeks. Because that's all you had, right? So it's rented for 3 weeks, you got a little cash flow. 99% of tax preparers out there have their software automatically fill in and say, this property was available for fair rental days for 365 days, right? So the lender looks at that and they're like, oh, that's not much income it can make. But if the tax advisor knows and the preparer actually puts the right amount, it was only there for 21 days, what happens then on that when they're looking at gross income or potential gross income?
Yeah, so it's still going to be averaged out over those 12 months. So you still need, a pretty strong portion of the year to generate income for it to be significant enough to make a difference in
I've
your
been
ratio.
told in some cases, maybe it's for DSCR loans though, but if you show the fair rental days on Schedule A,
It'll prorate it.
yeah, they'll prorate it. They'll say, okay, so if it was only available for half of the year and you collected $50,000, as long as the Schedule E indicates that, and it's not a first-year property, then you can prorate it and say this is income potential likely of $100,000.
Well, there's some variables that go into that, and it's going to depend on, do you own other properties? So there are some different factors that go into how that can be calculated. Our typical scenario is going to be they only own one. We've got to average that out over a 12-month period.
So I would suggest that whoever's doing your taxes, if you're into this, you have your tax advisor work with your lending advisor and make sure they're in agreement, because all lending underwriters, a lot of underwriters are very different. They should be talking to each other. Does your lender talk to your CPA and vice versa? If not, maybe you're not with the right one when you're doing this stuff. I want to get back real quick to what you said earlier. When you're just doing a normal standard loan, your debt to income ratio loan, you said accelerated depreciation is an add back. So let me get into the scenario again real quick. Let's say you buy $1 million property and somehow you get a $700,000 tax deduction on it because we got $700,000 in bonus depreciation. Let's say your income was $700,000 that year. Now you're showing zero taxable income because you got to take this depreciation, make sure it's reported properly on your taxes, because lenders won't fudge lines. If you tell them that's depreciation, if it's not on the right line, they won't accept it as that. The lender adds it back and now you have $700,000 of income again for your debt to income ratio. That is a beautiful thing. It's one of the other powers of depreciation. And I just want to throw in one other thing. Now that we have 100% bonus depreciation back, when you're considering what we just said about how that can be added back, there's a lot of things normally over the last 30 years in our career, right, Kevin? They'd say, expense everything you can expense. You don't want to call it a depreciable item because you don't get the deduction, right? How has that changed?
Well, with 100% bonus depreciation, whether you expense it or you capitalize it and then depreciate it, you get to the same end result. So it's for lending purposes, we want to push as many improvements or any assets that have a lifespan of greater than 1 year. We want to push all of that onto the balance sheet when you're doing your accounting, because then we are going to get the same bottom line on your profit and loss statement. We're just going to do it through depreciation instead of like supplies expense or furniture expense. If you buy like some chairs and they're $800, hey, let's capitalize that instead of calling it a chair expense on your profit and loss statement. Put it as a balance sheet item, put it on your depreciation schedule, and get the $800 write-off through depreciation. Because when you go work with Jeff, he's going to take that $800 and add it back to your qualifying.
Yeah.
So it's just those small things when a preparer understands real estate taxation, real estate lending, this whole process, then you can really maximize and get this 10% down. You can qualify for more property. It's just, but everyone needs to work together, and we work closely with so many clients, and we see it every year. I mean, for the past probably 4 or 5 years.
We get a lot of new clients that can't get lending, and they come to us and we're like, I thought you could do this and get lending. I'm like, you've expensed everything in repairs and maintenance. My CPA said it's better that way. As long as it was under $2,500 per item, I can do that. And we're like, but you can't get lending, can you? And we've amended the returns to correct them to the right way and done that. But
Well, and that's why it's so important to have an expert, to
Yes.
You have to.
someone who has really dug in, has experience, has put in the work, because it's not every CPA, not every lender knows what we know. And,
Yeah.
and I have those conversations every day where I was told this, and I explain, I'm sorry you were given bad information. You were given
I mean, you feel bad for
misinformation.
these people, but at the same time, it just makes our business so easy, right? When they come in and say,
really
but
does.
the CPA said you can't do this. Oh, yeah, let me tell you what the real law says.
Well, we get to look like a hero.
Yeah, we do, and we just
yeah.
know the rules. We're not actually smart. I happen to know you and I aren't very smart, but we know the rules.
That's right. We can read. We work hard.
Yeah.
And you can think outside the box.
Yes.
Because that you solve problems too. If a client
Right.
comes to you with a problem, it's not just like, oh, well, we offer these 2 products in these standard forms, and this is the only way to do it. I got to take your information and put it through these filters, and we'll see what pops out.
Right.
That's not what you do. And so Guys, if y'all are looking for your first, second, 10th, or 21st rental property or property, reach out to Jeff. So how do they get a hold of you?
Well, so when I first started doing this, I would have hour-long consultation calls where I would just regurgitate information, and it was about every 10 minutes asking if they were still awake. And just out of necessity, I was like, there's got to be a better way. So I created a website, STR Home Financing, tell a little bit about my story, gather a little bit of information, but then you get to 4 videos that really educate people on the 10% down product, the DSCR loan, how do you get pre-approved, the value that our team brings to the table. And so those are 20 minutes, and then you schedule a 15-minute call with me where we just cover any nuances that you may want to go over, clarify anything, and just make sure you have a clear direction on next steps.
What was that web address again?
strhomefinancing.com.
strhomefinancing.com. Jeff, thank you so much for joining us. You are a wealth of knowledge. I've learned a lot from you, and I look forward to continuing to work with you and have you back on in the near future. There you have it, the power of financing and how important it is to do the right kind of financing with the right lenders when you're going into the STR business. Thank you for joining us on the Hidden Money Podcast. We'll see you next week.